The markets fell as much as 900 plus points on Feb 24th, but this is not the first time we are seeing the markets bleed. The stock markets in India have been on a downward spiral for a quite long time. In fact, in just Feb itself, the BSE Sensex tanked over 2100 plus points. So what's happening in the markets and why? Let's decode everything in this video. I'm Neha Vashisht Mahajan. Let's get right into it. First off, let's take a look at some key data points. The Sensex has lost over 2100 points in Feb 2025. In fact, 6 months back, Sensex had touched nearly 86,000 levels and is now down to 74,000 odd levels, which is a fall of over 10k points and about 12% in percentage terms. FII outflows. FII outflows have also dragged the markets down in the last few months. As per latest data, foreign institutional investors have taken out over 1.01 lakh crore rupees in 2025 so far. Nifty is below the 22,600 mark from its peak of 26,000 odd levels from last year. In fact, Nifty is on the verge of its longest losing streak in 28 years. This downturn is fueled by aggressive selling by foreign investors and a shift in investment focus toward the recovering Chinese markets. If Nifty 50 declines in Feb, it will mark its first 5-month losing streak since 1996, only the third such occurrence in 34 years. When it comes to monthly, quarterly and half-yearly numbers, this is how much Sensex and Nifty have dropped. For Nifty, month change is a fall of 2.85%, quarter change drop of 5.70%, half-year change is a drop of 9.18%. However, the year change for Nifty is about 2% and is positive. For Sensex, month change drop of 2.71%, quarter change fall of 5.91%, half-year change fall of 8.19%, and the year change for Sensex is over 2% and is positive. Now coming to the major factors affecting stock markets in India and around the world. Number 1, global uncertainties. US President Donald Trump's tariff threats, a stronger dollar and a decline in the US services activity amid tariff concerns and cost pressures is causing the stress in the markets. Along with this, a drop in weak US consumer sentiment reflects growing economic fears. Key US inflation numbers could drive further market volatility. Number 2, concerns over stagflation. Slowing growth coupled with rising inflation in the US have added to market jitters. This trend threatens export-driven sectors like Indian IT and makes emerging markets less attractive to foreign investors who may shift toward safer assets like the US dollar and treasuries. Number 3, FIIs. Barring a couple of days, FIIs remained net sellers for all other trading days in 2025. As per NSDL data, FIIs have sold Indian equities worth 1.01 lakh crore rupees on net basis in 2025 so far. FIIs have been exiting India due to global risk of sentiment, Trump's tariff threats, concerns over interest rates, USD strength and weak corporate earnings, and most importantly, high valuations of Indian markets. The Indian rupee's low value and increased US bond yields also made Indian equities less appealing. Sectors like financial services, FMCG, capital goods, oil and gas and consumer services saw the most outflows. Now coming to expert views, as per Siddharth Vora of Prabhudas Leeladhar, investors should prioritize low volatility and quality, focus on top private lenders like HDFC, ICICI and Kotak. Be cautious about IT, pharma and FMCG as even defensives face selling pressure. Prefer large caps as they are more stable despite FII exits. Stay defensive. The market is now sell on rise instead of buy on dips, so focus on capital protection. Mohit Khanna of Purnartha Investment Advisors remains optimistic about the market's long-term recovery despite near-term volatility. He believes the worst of the correction may be over, creating a favorable entry point for investors. With improved valuations and strong fundamentals, he expects solid returns as the market stabilizes over the next 2 years. Well, that's all for today. Stay tuned to ET for more.